Are you curious or have you heard what a hard money loan is? Well, I am interviewing an expert today that is going to break down what a hard money loan is, how they work, and how you can use it as a creative financing option. Hello again. This is Connie with Buy Without Realtor, guiding you with the knowledge and tools to confidently buy your own home on your own. Today, I have a special guest joining me, and we are going to dive into hard money. We're going to understand what exactly hard money is, who it's for, and what it can do for you. So let's get started. My guest today is Carlos Ivy, president of Private Cash Funding and one of my dearest friends. He is a seasoned real estate professional with a BA in theater arts from UCLA and 17 years in engineering and construction. With over 20 years in finance and real estate, including 12 years as a broker, Carlos specializes in private money lending, construction loans, multifamily acquisitions, and residential developments, catering to both investors and individual buyers and sellers. Carlos, thank you for joining me today.
Thank you for having me. What a very humbling introduction. I certainly appreciate that, and I'm glad to be here. And hopefully, I can add value to your audience.
Wonderful, wonderful. Well, let's just dive right in. Let's go real basic to start, if we
Okay,
could. So, what exactly is hard money financing?
hard money is summarized very quickly is just a quick access to equity in your home. So let's say you own a home and you have equity in your home and you need the money quickly. Hard money, when it's originated, can fund your equity or, excuse me, your funding needs as quickly as possible.
Okay, so then how does that differ from a traditional bank loan?
Well, hard money is, again, it's asset-based lending. So you're looking at the equity in your property, whereas traditional financing would be contingent upon your debt, your income, your cash, and your credit. So a combination of the four, because that type of traditional financing could be highly leveraged. And with hard money, it's strictly based on the collateral, how much equity is in the collateral, and other risk factors have a weight in this underwriting decision, but it's basically based on the collateral that's in the property.
Interesting. Okay. So, what about interest rates and terms for hard money? How does that compare to like traditional financing?
Well, the higher the risk, the higher the rate. So if you have a property that is a highly leveraged property and the credit scores of the borrower or the sponsor are not that high, and he's had some challenges, then the rate is going to be higher. If the borrower is in a situation where the LTV is lower and he's got great credit, strong assets, then the rate is going to be lower. So the higher the risk, the higher the rate, the lower the risk, the lower the rate.
Hmm, interesting. So, then can you share what the advantages are of even doing hard money financing?
Well, I guess the primary advantage would be speed and then also documentation, because if you do a traditional loan, they want to understand about your income and your expenses and about your, obviously your credit background, but primarily driven is your income expenses and what's called a debt to income ratio. That has a lot of weight to do with traditional financing.
Okay.
With hard money, it's more driven upon the asset. What is the asset worth? How are you going to be able to service that debt? How are you going to be able to exit the loan? Those are the critical components to hard money. And they're relatively quick decisions to come to, because when you prepare a loan package, you want to understand what the borrower's exit strategy is. You want to understand how he's going to be able to service the debt payments, and you want to understand about the collateral itself, how much it's worth, and what the loan balances are, so on and so forth.
So, would this be something that a first-time home buyer would use, or a second-time home buyer, or
Oh,
an
no.
investor?
No,
Oh, okay.
this is strictly, primarily driven for investors. Um,
Mm,
the majority of all hard money is going to be non-owner occupied
mm,
business purpose loans. And if it does have a personal component, then normally these you cannot get an exception and your loan will be declined because you can't use a hard money loan for consumer purposes. So the hard
um,
money loan is designed for a real estate investor who
mm,
wants to do a fix and flip, who wants to build a spec home, who wants to buy an apartment building, who wants to
yeah,
buy, an industrial building, something like that, where you can get in and get out really quickly and get the loan funded as quickly as possible. They
yeah.
don't do a deep dive into your personal assets unless you're getting to an apartment building and your debt service, coverage ratios are low to the point where the sponsor's got to make contributions, to the debt service. Then they're going to want to see what your personal net worth is and how you're going to be able to make the debt service payments when there's obviously you're upside down in the loan. So
Got you.
um, those are some of the criteria.
Got you. Okay.
Yeah.
So are there any risks or downsides to investors if they were to
Oh,
use
absolutely. But
Oh, okay.
typically not. Yes, there are risks, and that's the to leverage to alleviate that risk. The investor wants to make sure that the sponsor has got skin in the game.
Mm,
So with your traditional lending, they will highly leverage, a an acquisition or a refinance. But with hard money, they want to make sure that the sponsor or the borrower's got some type of equity that he's put into the deal. And then they will execute the loan. So there are risks, but the risks are minimized. And like I said, the higher the risk, the higher the rate, the lower the risk, the lower the rate.
so when you talk about equity, does that mean cash in hand, or can they leverage another property and use that in terms of, skin in the game that you're talking about?
Absolutely. It's called cross collateralizing. So
Mm.
let's say that you have a property, the subject property where you're going to be, purchasing or refinancing, then you have maybe two other investment properties. You can definitely leverage the equity in those investment properties based on, like I said, the value minus the loan balance would be your equity. As long as there's equity in those properties, you can definitely use those as cross collateralization. I've even seen where sponsors or borrowers purchase properties at 100% LTV because they've cross collateralized some of their other properties.
Oh,
So
wow.
it's
Wow.
totally possible. So you can absolutely get creative if you've got equity in other multifamily, single family residences or multifamily properties or whatever
Great.
assets.
Excellent, excellent.
Mhm.
So what type of properties or specific types of properties would be useful for hard money loans?
Well, again, your fix and flip would be
Okay,
probably your primary cookie cutter. A
all
lot of the
right.
people you see on these television shows, they have purchased the property, then they have a rehab budget, so they
So they're
rehab the
using
property.
hard money? So on these programs, they're using hard money to get their financing?
The majority of them are, yes, yeah,
Interesting.
yeah.
Very good to know.
Yeah. So,
Interesting.
yeah. And, hard money is used also for bridge. When I say bridge, let's say you need money to leverage your existing property. You want to buy another investment property. And if you have enough equity in your existing property, you can use that equity to liquidate, turn it into cash to acquire another piece of real estate. So that's always an option as well.
Interesting. Interesting.
Yes.
Can you also talk about exit strategy? I know that you had mentioned this in another conversation that we were having. And I want to know what would be the importance of exit strategy when you're doing hard money financing.
Exit strategy is the key. I mean, because the hard money is like a band-aid, let's call it. It's short-term financing, and it shouldn't be used for any long-term plays. Typically,
Mm,
you see a hard money loan anywhere from 6 months all the way up to about 5 years, and that would be the cutoff. I mean, because who wants to pay these astronomical interest rates for something 20, 30, 40 years. You want to
Yes.
at least get yourself to first base, get the property, fix it up, get it stabilized, and then move into more traditional financing. So that would be the play, and that would be the reason why people would utilize hard money. It's just a strategic play to get to where you want to go.
So, and I know this is going to be off topic, kind of.
Sure.
So I know that you said that non-owner occupied homes would be perfect for hard money financing, correct?
Yeah.
So
Yes.
what if a first-time home buyer, I know, a first-time home buyer, if they wanted to buy a home, fix it, flip it, and maybe 6 months down the line they wanted to live in it.
Well,
Or
then if they want to flip,
or maybe they don't flip it, they just fix it and use the
yeah,
hard money financing, live
yes,
in it for 6 months, and
right.
then sell it. Could they do
And
that?
everything is just being transparent with your lender.
Mm,
And the lenders, if they lend money with one goal in mind, that you're going to fix it and sell it, and you change your mind,
mhm.
that's fine. But you have to exit their loan and get into a more traditional loan. And of course, every
Oh,
time you borrow money, there's loan fees. So you want to be really dialed in and focused in on what you're going to be doing with the money and what your exit strategy is, and kind of stick to what your game plan is.
okay.
Because if you continue to change your mind, you're just going to get beat up with loan fees and all the other fees that go along with doing a new loan.
Okay. Well, then this definitely would not be
But
conducive
definitely, yeah. I mean,
for a first-time home buyer.
yeah, well, first time home buyer is probably not the ideal,
Yeah.
scenario. But if you wanted to buy, fix and flip, or you wanted to buy, rehab and then hold, then my suggestion is you buy with the hard money, you rehab, and then once you get the rehab completed, then you refinance into a more traditional loan. So,
Oh,
or you buy, let's say you have units. Let's say you buy and then you stabilize. That means you get many units as you can stabilize with the renters in there, and then you can use the income from the rentals to qualify for a new loan.
hi there. I'm Connie Mackey. And if you are navigating this home buying process all by yourself, I got you covered. And even if you just have general real estate questions, or you need to brainstorm ideas, or just ask a question, no matter how crazy it is, I got you. Book a one-on-one consulting session on my website. The first 10 minutes are free, so why not give it a try? Allow me to help you with any real estate questions that you have, and to make this home buying journey as stress-free as possible. Oh, now that's quite a strategy. I
Yeah,
like that. That's a great strategy.
yeah, that's pretty common actually.
Interesting. Okay,
Yeah.
very good. All right. Sometimes common isn't so common to everybody. So tell me, Los, Carlos, sorry. I know I slipped again. I slipped
No
again.
worries. We go back a long way.
Yes, we do. Yes, we
That's
do.
that's a name of endearment, I know.
So, what do investors need to know before considering a hard money loan?
Well, they have to really understand the project.
Okay.
Understanding the project is important. Understanding, what your rehab budget is going to be, keeping, the cost of the rehab dial in, and what your exit strategy is. What is
Ah,
it that you're going to do? I mean, that's the key. Are you going to
mm-hmm.
hold it? Are you going to, are you going to be selling it? Understanding your exit strategy is really, really paramount and important, before you do your acquisition. So
Yes.
it's just like, taking your road trip. You plan your road trip, you plan where you're going to get gas, you plan where you're going to stay, and then boom,
Right.
you get to your destination, and then all is good. So it's the same with, doing these loans. I mean, again, hard money is expensive,
Mm,
very pricey,
mm.
but it's a means to get from A to B. And then, once you have your B situation, understood, you need to have an exit strategy for getting out of the hard money loan because it is pricey.
Okay, all right, good to know.
Mhm.
How about some specific regulations or legal considerations that an investor would need to know about in terms of the hard money loan?
That's a good question. Um, since it is a business to business loan, it's not as regulated as a consumer loan. And when
Really?
oh yeah, absolutely. When you're working with a consumer loan, you've got every protection that one could afford. When
Yes.
you're when you're doing business to business, it's like they say, buyer beware.
Okay.
And you really have to be on your pins and toes, and really understand what you're getting into, because again, it could be very pricey. You make a mistake, it could be very, very costly.
Oh,
So you really have to understand what you're doing. But repercussions, I mean, with hard money, the investor or the lender, they control that collateral. And if you default, they take the property back. Now, I want to clarify,
hmm.
these hard money lenders and investors are not in the repossession business or foreclosure business. Their
Understand.
primary goal is to lend money and make money off fees.
Okay.
So they're not in the foreclosure business, despite what a lot of people think and their
Of course.
reputation. But it's
Yep.
really important to understand that they look at foreclosure as a last option, and that's not their business model. So it is a painful process for them to go through, because they lose money with the not collecting on the debt service, and the foreclosure process takes a while. And you have to go through judicial system, depending on what state you're in, and it can be very, very, time consuming. Of course, at the end of the goal, hopefully if they get possession of the property, they can sell it and maybe break even or make a small profit, but that's not their business model. Their business model is to lend money and
Yeah.
make money on fees.
Understand.
Yeah.
Understand. So then share from a lender's point of view,
Uh-huh.
what makes a borrower attractive? What,
From
what, an attractive candidate for a hard money loan?
Well, a attractive candidate for a hard money loan would be a good, solid, collateral, making sure that the property that's being acquired is solid, and the value, they're comfortable with the value, understanding, the borrower's liquidity, understanding what their goals are, understanding, what their, track record is, and understanding that there's an exit strategy, and clearly understanding what they want to do.
Mm,
Um, so once that's done, that the more information a lender has on a borrower, and he's able to check out their history, their historical performance, being able to get verified what the asset is about through an appraisal or broker price opinion, and
mhm,
understanding what the exit strategy is, that determines a good deal. So if you got a
mm.
strong candidate, you have a strong piece of collateral, and you understand the exit strategy, that would be the three components that I would think that would qualify for a good deal.
Okay, all right. Well, I don't want to take up a whole bunch of your time today, so I just have one last question.
Okay.
What would you say is your true area of expertise?
Thank you for that question. I would say my true area of expertise is multifamily. And
Oh,
understanding, yeah, I do a substantial amount of multifamily, and it's interesting. I mean, because a lot of people have got an illusion about multifamily, and it's very, very simple. It's very simplistic. I mean,
yeah.
because the property has got to make money, and no matter how much debt you think is going to be to your advantage, I get a lot of people that come to me and say, "Hey, look, what's your minimum down payment?" Well, that's the wrong question, because the more debt you have, the higher your payments are going to be, and it's going to impact your return on your investment. So there's a couple components that are tied that are really, really important. It's the purchase price, and it's the income from the property, and
Mm,
it's the expenses from the property.
hmm.
You have your net operating income, and then from those numbers you're able to determine what your cap rate is. So right now, cap rates are becoming higher, and they're trying to catch up with where interest rates are, and it can be a unique situation. So if you find yourself in a situation where the front end of the deal looks good, but the back end of the deal looks bad, where your debt service is high, then you have challenges with your debt service coverage ratio. And typically, lenders like to see a debt service coverage ratio of 1.2 or higher.
Okay.
Some, roll the dice with a lower, debt service coverage ratio. But typically, they like to see a debt coverage ratio of 1.2. By the way, I have a video on my YouTube channel about debt service coverage ratio that goes into debt service coverage ratio extensively
Great.
and explains a little bit better. But to answer your question, Connie,
Yeah.
that's my area of expertise.
Okay.
Is multifamily and putting
Right.
those deals together. So you kind of have to play with the whole scenario and understand what your down payment is going to be, what your debt service, what your payments are going to be, and understanding the income from the property and the expenses. And it could be kind of like a game of cat and mouse, because the seller of the property wants to make his property look good, and the
Of
buyer
course.
wants a decent deal or steal. So there's a cat and mouse game that gets played when you purchase a property, because the listing agents or the listing people or the seller will inflate the numbers of the income and play with the numbers of expenses to make the thing look good. And once you start getting in there and analyzing it, you find out that it's not that good of a deal. So it's important to do your preliminary analysis on a property to understand if it's a good deal. And you and I have discussed this. I've created somewhat of and I'm sorry to be long-winded here, somewhat of a template that allows you to do a preliminary cursory look at a deal and crunch the numbers to see if it's going to be a good candidate for a loan.
Yeah.
And I would be happy to share that with you at any time.
Awesome. Awesome. Appreciate that.
Yes,
Well,
no
look,
worries.
I am not going to keep any more of your time because I know you've got deals to do. So,
Yes.
how can people get a hold of you?
Well, I have a website. It's www.privatecashfunding.com. And they can also reach me at carlos@privatecashfunding.com. That's my email address and my website.
Fantastic. I will also put that in the description below if somebody wants to reach out to you regarding any hard money financing. And I can't tell you how much I appreciate the time that you took for today. Might be a little bit over the head of some of my first time home buyers or second
Right.
time home, but the investors that watch my video will absolutely love this. And I will definitely direct them over to your website.
I certainly appreciate that. I'm sorry about the long-winded answer to the multifamily, but it is complex,
Yes.
and I'd be happy to help anybody walk through the process so they clearly understand that debt can be your enemy.
Yeah.
So I'd be happy to walk them through that process and kind of explain that to them. But I certainly appreciate your time, and thank you very
Fantastic.
much for having me.
Wonderful. Thank you so much for coming. Wow, that was quite an interview with Carlos. And again, I will make sure that his information is in the description below if you have any further questions about hard money financing. I am also going to have a link in the description for my new ebook called Home Buying Made Easy. It's a step-by-step checklist on how you can buy your own home on your own. And if you like this video, please be sure and hit that like button and subscribe for more creative information and more creative videos just like this one. And remember, with the right strategy, a little bit of confidence, you too can buy your own home with Buy Without Realtor. Thanks so much for watching. See you next time.